start doing is answering your questions, and that's going to take us in a slightly different direction than we were going in at the end of the last class. We're going to accelerate something I was going to cover anyhow because you guys wanted to know about it. And that's fine. You know, we'll get to everything eventually. So the first question had to do with material that we covered before, which is how does H disappear? And in particular, this is the question I got. If Fed still belongs to private banks, where does it put the money received from the private banks? Why? Private banks use domestic currency to buy central banks' foreign bonds. Okay, so I guess there's two questions there. One has to do with foreign stuff. We'll put that off till later. But the first question, when the Fed sells a bond to a private bank, where does it put the money received? So let's just look at this carefully. So we have in front of us the spreadsheets, and we can think about it. So we have our private bank. We have a before and after. Private bank, central bank. Private bank, central bank. We're going to talk about an open market operation to reduce the size of the Fed's balance sheet, or equivalently to reduce the money base. And that involves selling assets, because we're going to shrink the size of the balance sheet. So we're going to sell a treasury bond to the private bank. So treasury bonds at the Fed start at 1,000, and they're going to, 2,000, my apologies, they're going to go down to 1,900. And the bank is going to send some of its reserves back to the Fed. And the question was, and what happens then? And this is definitely one of those mysterious things that's sometimes hard to grasp, but it's actually really straightforward. The Fed makes them disappear. I think in class I had somebody rip up a little piece of paper for me. Literally, the Fed takes those reserves that Bank of America sends back to it, and they disappear. They no longer exist. They evaporate. Use whatever verb works for you. The Fed takes them out of existence. The Fed kills them. You like that, you know? Whatever verb helps you. It's weird, you know? I mean, if we pay for something or somebody else, money doesn't just kind of appear and disappear out of nowhere in our daily existence. So it takes a little getting used to. But that's what's going on. Literally, the Bank of America pays the Fed, gives it back the reserves, and the Fed just makes them disappear. And if you think about it, what else would the Fed do with the bank? Would the Fed put it in its bank account with some other bank? The Fed doesn't have bank accounts with other banks. The Fed is the central bank. So the Fed could put it in another account with itself. Well, what's that? That's kind of the same thing as making it disappear. You know, it's no longer of use to anyone. Nobody's going to use it. So it's kind of, that would be like putting it in a vault where it's not going to do it. So basically, the Fed gets it and it's gone. And that's okay. That's just how the system works. It's weird, we're not used to it because that's not our daily life, but that's how it works. Another question that came up was seasonal adjustment. So I'm going to jump ahead to the slides on seasonal adjustment and just highlight the key things that I want you to take away from that discussion. So the first thing is, what does seasonal adjustment have to do with? It has to do with data that has seasonal patterns in them. And I used as an illustration the once-a-year pattern in the money multiplier in the United Kingdom, which comes from the once-a-year pattern in currency preference in the United Kingdom. So that's, I want you to know when you see seasonally adjusted or not seasonally adjusted, you know what you're looking at. Seasonal adjustment, the normal meaning of the word seasonal adjustment means you take the underlying data series, like the magenta line here with spikes, and you smooth it out. You find a way to even it out while you maintain the same average value over each year, but you smooth out the spikes so that when people analyze those data, it's easier for them to see underlying trends. That's the goal. And there's a zillion different ways to smooth it out, and we're not worrying about it in this class. If you ever need to know, you can figure it out. The last thing I talked about is ways to calculate growth rates to avoid getting the growth rates, to get smoother growth rates than you get, than you sometimes get with seasonal adjustment. And I highlighted two different ways to calculate growth rates. I'm going to have a problem set for you soon in which you will calculate them themselves, and at that point, that's the right time for you to go back, review the exact formulas, and I'll probably put them in the problem set for you, and you'll be able to compare for yourself growth rates and different things like that. So I think the best time for you to dig into that, the different growth rates, is when I give you the problem set, and it'll, at that point, by doing it, it will become more clear to you. The third question that Chicago highlighted for me, is this one. How does foreign exchange intervention affect the money supply? Or more specifically, the words I got were, how does the central bank strengthen the home currency by selling foreign bonds to banks? The relationship between the exchange rate, outside money, and the money supply is very confusing. So that's what we're going to talk about today. We definitely need to talk about it. I have a whole set of lecture notes on it, and since I got this question, that's what we're going to do. So intervention, as I've shown you, affects high-powered money, and in particular, when a currency tends to appreciate, intervention is going to tend to raise high-powered money, and then ultimately the money supply. And vice versa. It all goes the other way when a currency is tending to depreciate when a country, again, wants to stabilize the exchange rate. So what I'm going to do is review that, go into more detail about how that process works so that you have a deeper intuition for it, and then I'm going to introduce some related concepts. There's this thing called sterilized intervention, which has a lot of syllables. But the basic idea of sterilized intervention starts with, okay, you're a central bank, you want to control the exchange rate, you don't want it to go up or you don't want it to go down, but you also don't want to change the money supply. Is there some way you can intervene in the foreign exchange market without having a change in the money supply? Is there some way to pull this off? That's what sterilized intervention is all about. It's about that quest for some way to intervene without having an effect on it. So we're going to talk about sterilized intervention. What is it? There's different ways to do it, and this is going to bring up some interesting questions. So there's a classic way to sterilize foreign exchange intervention, and then there are additional ways that countries have been using over the last decade or so, including China very much. One is that the central bank, instead of trading in existing government bonds, can issue its own. We're going to talk about that. And also, the central bank can change the required reserve ratio that banks operate on. And as you know, China has been doing that a lot for the last 15 years. So we'll talk more also, while we're there, about why sterilize it. What is the evidence? Does it work? If you sterilize your intervention, will it actually lead to a permanently changed exchange rate or not? And we'll talk a little bit about how central banks view sterilized intervention. And then I have a little discussion about high foreign exchange reserves, which many, many countries have accumulated mountains of foreign exchange reserves in the last 20 years. And so there's debates as to whether they have too much or not. So I'll introduce you to the debates. I don't have a dog in this fight, but you should at least know what the debate is. Okay. So here's an image that's important for us in thinking about intervention, and it's been in the background as I've been talking about intervention all semester, and it's time to bring it into the foreground, which is just basically think about the foreign exchange market as a normal market that works with supply and demand. And I've been talking about it that way, but let's put up a little chart, supply and demand. So what do we have? Suppose we're thinking about the market for some foreign currency versus the dollar. We're going to talk about quantity as the number of dollars. And in fact, here's something I learned from somebody in the market many years ago. Just in thinking about exchange rates. So most foreign exchange rates, which by the way, I abbreviate exchange rate as XR. It's just, exchange rate is very long, and I write it a zillion times, so it's just nice to have abbreviation. So you may run into that. XR. The exchange rate is usually the foreign currency, the non-dollar currency, per dollar. Normal. There are exceptions. We can talk about those in a minute. But that's how it's normally quoted. So, but what you've got is one money in terms of another, which makes it inherently confusing to think about exchange rates. And in general, in international macroeconomics, everything's inherently confusing because you have two of everything. You have two monies, two interest rates, two price levels, two GDPs, and I just got started. So one of the problems is there's no way around this. It is. So what I've done over the years is I've created little mental rules of thumb that help me go sort it out. And as we go through the semester, I'll be sharing those little rules that I use to sort it out. But one of the rules I use, I got from a woman who was rising rapidly at Citibank in the foreign exchange group many, many years ago. And she called this the commodity currency. People also call it, more commonly, people call it the base currency. So I've come to realize over the years that it's really helpful to me to focus on the base currency. And I'll tell you why, and then I'll tell you why the word commodity has been helpful for me. So it helps me to focus on the base currency in the following sense. When an exchange rate goes up, it goes from, say, 1 Argentine peso per dollar to 3 Argentine per dollar. Whenever an exchange rate goes up, we have to say, okay, which currency gained value? That's always critical to know. One currency is gaining value, one currency is losing value. And you have to know which, or you really can't think economically about it with any value. So it's always the case that when the number goes up, the base currency appreciates. The base currency gains value. Now at some level this is totally obvious. But at another level, what I'm trying to say is when you're thinking about all this stuff, you don't have 5 minutes to sit there every time and go, okay, one of these currencies gain value, which one is it? Let me make sure I get this straight. You need a quick rule for figuring it out so you can go on with the discussion and go on with your work. So I find this is my quick rule. The base currency, if the number goes up, like this one, the dollar has appreciated. And now if we think about it, it makes sense. The dollar was worth 1 Argentine peso, now it's worth 3 Argentine pesos. Okay, it's worth more, so the dollar has appreciated. It's the same thing as a house. If the house goes up, we say it appreciates in value. If a work of art goes up, we say it appreciates in value. If a building's value goes down because it gets old, we say it depreciates in value, which would be the symmetric to this. If we went from 3 Argentine pesos to 1 Argentine, if we went the other direction, we would say the dollar lost value or it depreciated. So the denominator, the base currency, is the one that moves in parallel with a number, whose value moves in parallel with the number. And I find that intuitively it's just helpful to stick with the one that moves the same. So that's my anchor. That's my mental anchor for quick thinking when I'm thinking about exchange rates. And so that's why I think about the base currency all the time. Now, the commodity currency idea is helpful. Let me extend the analogy to a work of art. Normal day-to-day prices, when we go to the store, are money per thing. $4 per loaf of bread. $60 per visit to the doctor. $1,000 per ridiculously large TV set. Okay, it's money per thing, per, generalizing, per commodity. So when you have an exchange rate that's pesos per dollar, it's like the thing in the denominator is like the thing. It's like a commodity. See a lot of yeses. Okay. I'm not getting any answer from you, so I'm like, oh, have I gotten this? Okay. So I find it helpful to think of the base currency as the commodity currency because it helps me go back to the idea of the exchange rate as a price, just like any other price. And just like any other market that has a price, the exchange the market for currencies operates by supply and demand. The thing that people are buying, you can think of as the commodity currency, which in most cases is the dollar, the base currency. So that's why I have the quantity here listed as dollars. Excuse me 2 seconds. The shades just went up. Does anybody object? Is that a problem?
I think it's from the board.
It's a problem with the board. Okay. So think of the market for currencies as the market for anything else. It's just a little weird because the two things involved are both currencies. But one of them is like the thing you're trading, and the other one is like the price currency. So she called it the commodity currency and the transaction currency. So the numerator she called the transaction currency. And again, the analogy to the market for any commodity comes out directly. So I'm going to talk about that in terms of intervention and understanding it at some length. But before I do so, let me just highlight a couple of exceptions to the little rule I gave you over here, that normally the dollar is the base currency. There are two really important exceptions to that rule. One is the euro, and one is the pound. And in fact, it's actually a group of currencies in that second. It's the pound and the other Commonwealth currencies, the Australian dollar and the Canadian dollar most notably. So, you know, you go around the world, you list a bunch of countries. Let's go through Latin America. Mexico, Nicaragua, Guatemala, Honduras, Panama, Colombia, Ecuador, Peru, Brazil, Argentina, Chile, Bolivia, Paraguay, Peru. Did I get them all? All right. Then we got Africa. List all the countries in Africa. Then we got Asia. List all the countries in Asia. All of those currencies are quoted as foreign currency per dollar. But there are these two exceptions. They happen to be big places, but nonetheless, the euro and the pound. How come? It's worth just pausing to talk about why are these exceptions. The pound is the base currency vis-a-vis the US dollar and wherever it trades, with the exception of the euro. Because United Kingdom dominated world trade and payments in the 1800s. It was the base currency for most transactions because it was so central. Between World War I and World War II, the United States came into dominance, and especially after World War II, when the United Kingdom was kind of destroyed, we dominated just by virtue of being the last man standing after World War II. And so here we are. But that's how the pound ended up being an exception to what is now the rule. The other exception, the euro, has a different story that is kind of interesting, I think. So being the base currency has these kinds of overtones of strength and machismo, all right? And so when Europe created its own currency, they decided they were going to control whether it was the base currency or not. It was kind of like, and we're going to be the base currency. If you want to trade our currency, we're going to be the base. So basically, it was kind of like that. I'm sure I wasn't there at the meeting, and I'm sure nobody phrased it that way. But anyhow, that's what happened. They just decided, all right? They just decided. All right. So, and then the last thing I wanted to mention about that, in the foreign exchange market, if I'm at a hedge fund and I want to trade dollars versus Mexican pesos, or dollars versus Japanese yen, you name big currency, Hong Kong dollar, Singapore dollar. Okay, I call the dealer and I say, I want to buy 5 million. Well, first of all, I don't say 5. I don't say million, I say 5. Right? And I don't call these things, it's all electronic. But here's the thing. I don't say million because it takes too long. And I don't bother saying what units. If I say 5 million, it's like, well, 5 million less. You want to buy the Hong Kong dollars? You want to buy the US dollars? How do they know? They know because it's always the base currency. There's a conventional way to quote the exchange rate, which is what I was just talking about. And it's always, the units are always in the units of base currency, unless it's a special thing and someone says, well, we have a special deal now, I want to explain what I'm doing, and walk through it really carefully. I want 5 million of the numerator currency, whatever. So unless it's stated otherwise, the units are always the base currency. And that just makes the market efficient. Okay. So now we're talking about intervention, and just to be concrete about how intervention works, what I have said before was, okay, if you want to raise the value of your currency, you buy it. And that's really all there is to it. So, I mean, in basic intervention, that's what's going on. So we have a market with private supply and private demand. And if they were all that was going on, we would have this exchange rate over here, which will denote E, and superscript private, for that's the equilibrium exchange rate we would have if we only had private agents. So private agents would be asset managers, mutual funds, hedge funds, pension funds, endowments, banks. It would be large multinationals, it would be small and medium-sized enterprises, it would be rich people, and these days it would be retail customers operating through retail brokers. That would be private. And you can see, by the way, that the exchange rate, I've got the way we quote it as a subscript, because it's really important to keep that straight. Okay, so that's the equilibrium we would have without intervention. But suppose the government wants a weaker currency. So the foreign government wants a weaker value of its currency. So what are examples of this? Japan, in 2003, after 13 years of sluggish economic growth following the bubbles in the 1980s, Japan decided it was finally going to work on the exchange rate. It wanted a weaker value of the yen to stimulate exports. So for a year, they intervened aggressively to weaken the value of the yen. The yen is not one of the exceptions to the rule. It is always quoted as yen per dollar, as you know. The normal exchange rates are like someplace between 85 and 110, and sometimes it goes beyond that. So that's an example of when a country wanted. So I forget where it was in 2003, but there have been times recently when it was in the 80s, and they don't want that. I should put the 85 down here. The range is 85. This is kind of an average range. Yeah, something like that. And they don't want it down here. That's too strong. They want a weaker yen. But that, there's lots of examples of this. China. A lot of China these days wants a weaker home currency. So this is the private equilibrium down here, and they want the exchange rate somewhere else. So what do? The central bank is going to add total demand. Enough to get the exchange rate where it wants to be. So the supply curve is the red line. The exchange rate is going to be somewhere on that line. The private demand curve is down here, and with just private demand, we can't get to the exchange rate they want. So the central bank is going to intervene. It's going to buy that much. How do we know that much? Well, at that exchange rate, we know the demand is over here. So to get us over here, that central bank has to be buying the extra. Okay. So that's the general idea. And then if you want to, we'll go through an example where the central bank might want to weaken the currency, strengthen the currency later. But it's the same general idea, but the exchange rate's underneath. So instead of buying, the central bank is going to sell its own currency. So that's the general idea. How does that work in terms of the balance sheet? Let's go back to the balance sheets we looked at before. We have our private bank. We have People's Bank of China. Now we're in China. We're trying to intervene. We're no longer in the United States, so our central bank has a new name. And but for convenience, our bank looks an awful lot like the banks we looked at before when they were American banks, so we don't have to adjust our minds on the numbers. So here's where we start. People's Bank of China trying to weaken the, RBM, it's RMB. I know that, I do currencies, that was just a typo. So they're going to buy, oh my goodness, this slide is full of typos. 100. A couple of years ago, all right, so they're going to buy $100 billion from private banks. they're literally buying dollar deposits. They pay the banks by increasing their reserves. And now high-powered money has gone up. And literally what they're doing, so technically what's going on here, there's actually two steps kind of embedded in here. And they're not very important to keep straight, which is why I haven't really brought them out to you. Technically speaking, what the banks have on their books are U.S. Treasury bonds most of the time. They're bills or short-term securities, not deposits. So there are some of those. So it's kind of a two-step process where the central bank buys the bond. Well, the central bank wants to buy the bond, but to buy the bond, the central bank has to have dollars to do it. So it ends up going through the foreign exchange market any way you look at it. It has to get the dollars. Okay. So, and then you'll remember from previous classes what happens next. What we have done so far is we have increased high-powered money. That's like putting more gold into the system that we created here. That's not necessarily the case. It's increasing the money supply. At this point, the extra high-powered money that we put in the system is all in the banks. So it is not money. And in fact, this raises an interesting and important question that one of your classmates asked recently. So at this stage, the private bank initially, we're going to look at our private bank. We're going to look at the actual reserve ratio. And then we're going to compare that to the theta that we usually have in our money multiplier. So initially, our private bank, so start, so our private bank starts with a reserve ratio of 500 over 5,000, which is 0.1, 10%. Then what happens is it ends up with, what do we have here? Got paid, right? 600? I can't see it. 600, right? Yes. It ends up with 600 over 5,000, which is greater than 0.1. And so the student said to me, well, shouldn't that mean that the money multiplier changes? It's a totally reasonable question. So there's an important distinction in the background here, which is the desired reserve ratio. What does the bank want to achieve? That's what goes in the money multiplier. We're going to say that that's constant at 10%. So initially, the bank is at its desired reserve ratio. Then the central bank comes along and raises reserves by buying an asset. Now what happens is the bank is above its desired reserve ratio. It has extra reserves relative to where it wants to be, and that's what it's going to lend out. And when it starts lending it out, that sets in motion the whole deposit expansion process. And eventually, the banks will get back to 0.1, and at that point, the whole deposit expansion process is done. And the whole money multiplier thing has done its work. So the desired reserve ratio stays constant, and it tells us once they've adjusted to this, where will we be at the end? But in between, there may be moments where each bank has more reserves than it wants, and what it's going to do is lend them out. Does that make sense? All right, so I want to illustrate this. So this is now, we're going to look at a specific country, Bulgaria, that was in this kind of situation that we're talking about, where they wanted to weaken their own currency. So what was going on? This was in the early 2000s. Bulgaria had done most of the transition to a market economy, at least the initial stages of it, and we had low interest rates in the developed world, so there were massive capital inflows into Eastern Europe, all of Eastern Europe, and Bulgaria was one of the countries that experienced that. So this chart shows you the stock of foreign assets and foreign liabilities in Bulgaria, not the flow, but we can infer the flows. So the magenta line gives you how many assets Bulgaria owned in the rest of the world at the end on December 31st of each one of these years. And the blue line gives you the amount of assets that were inside Bulgaria that were owned by foreigners on December 31st of each year in the chart. And you can see that the gap is getting bigger. So what that tells you is, on balance, more foreign capital is flowing into Bulgaria, buying assets that are in Bulgaria, than Bulgarian capital is flowing out to buy assets. So you can infer the flows by looking at the stocks. Okay, so this is our situation. We have now inferred that Bulgaria had massive capital inflows during these years. And what happens when massive capital inflows happen? Country's currency tends to appreciate. All those foreigners want to buy factories and land and bonds in Bulgaria. And to do that, they have to buy the Bulgarian currency, which is going to tend to appreciate the value. But that, a stronger home currency, has bad effects on on trade. So they didn't want that. And in fact, the Bulgarian government, the central bank, has had a fixed exchange rate vis-a-vis the euro since 1997 or 98. So that's what this second chart shows you. But fixing an exchange rate takes a lot of work. It doesn't just happen. You don't just say, that's the exchange rate. There used to be countries that did that, and I'm sure North Korea can still do it. But any country that actively participates in world financial and trade markets these days can't just set by law what they want their exchange rate to be. They have to work with supply and demand. So what happened? To keep the value of the lev from appreciating. So to be more specific, with all that foreign capital flowing in, if the government had not intervened, would the exchange rate number have gone up or down, calculated as lev per euro? So again, let me frame the question again. The exchange rate is lev per euro. There were tons of foreign capital flowing into Bulgaria. If the government did nothing, would the number have gone up? Down. Very good. Okay, the number would have gone down. Obviously it didn't. How did they avoid that? They did what I was showing you in our little supply-demand picture. They wanted a number higher than they would have otherwise had. So they came in and they bought their own currency. I'm sorry. They bought the foreign currency. They bought the base currency. They bought the base currency. So what happened to their foreign exchange reserves? Well, they were buying euros in the foreign exchange market. So their euro, the stock of euros, it's denominated in US dollars, but nonetheless, the stock of foreign exchange reserves that Bulgaria had went up throughout this period. So that reflects the effort they were making to keep that fixed nominal exchange. It didn't just fix itself. It got fixed through a lot of work by the central bank. Wait.
Would that bring hyperinflation?
Great question. Let's make the next set of connections. That's a really good question, because let's remember, all that intervention is increasing high-powered money. Well, it certainly could. In Bulgaria's case, it did. So here is inflation in Bulgaria. It started out early in the 2000s at about 3%. And by the end of this whole era, everything stopped. This whole story stopped in 2008. By that time, their inflation was up to 12%. And there is nothing unusual about this story. So let me just give you a couple other examples. Remember in 2006, 7, 8, oil prices were going up rapidly? Well, so what does Dutch disease say should have been happening without intervention to the currencies of the oil exporters? So oil exporters, oil price going up, what will tend to happen to their currencies if nobody like a decrease, depreciate. Oil, so you got to remember our Dutch disease. If we rely on a primary export commodity and the price of the export commodity goes up, currency will depreciate, whatever it says. It'll actually appreciate. It will. And there's an analogy we can draw to the capital flow. Here's how it goes. We're selling oil. We get more people buying our thing. So the dollars come in. We got to turn them into local currency to invest in more oil wells and refineries or schools or whatever we want to do with all those dollars. So the natural tendency when the oil price goes up is for the local currency to gain value. Well, the oil exporters don't like that either. All right? In fact, Saudi Arabia's had a fixed exchange rate with the US dollar since 1986. 30 years. So that story is the same one we just played out. Their currency was tending to appreciate. They didn't want it. They had to intervene. They did exactly what we have in this story. They had to intervene by buying foreign currency, but selling their own against it. They bought the dollar, which was a base currency. Their foreign exchange reserves went up. High-powered money was going up. And in 2006, 7, and 8, the oil exporting countries of the Mideast were suffering from really nasty inflation. Again, it was on the order of 10, 12%, which was not normal for them. And it was the same connection to the intervention they were doing to maintain the fixed exchange rate that we just outlined for regulation. This is often mixed in the press. You will often find press reports of inflation here and inflation there, which I know because I'm an international economist. It's like, well, they're intervening. What do you expect? This is subtle. It's deep in, and the press often misses it. But once you know this stuff, then it's kind of obvious. It's like, well, of course they're going to have inflation. This is a tough situation. They're intervening. So never, always remember, when you see inflation in some country, to wonder, is it an intervention story? Because it often is. Not always. There's a lot of reasons that cause inflation, but this kind of thing, not unusual. Right. So you can see the Bulgarian foreign exchange reserves went up, money supply went up, and then they got inflation. Other consequences, there was a surge in capital investment relative to GDP during this period, which is kind of nice. It's not like everything was terrible. So there was but sometimes credit expansions can become excessive, and you can get too much investment. Well, I'll skip that. Okay, so now let's take the flip side. The government wants a weaker home currency. So the private exchange rate would be in the same place as it was before, but this time our government wants wants a stronger home currency. So again, when we have examples of this, there's so many, I almost don't want to start. It's always happening. Venezuela right now, just to give you one. But historically, there were millions. So what happens? The government wants the exchange rate to be down here. The private agents would have an exchange rate that's much higher. So the central bank, to get the exchange rate down, there's got to be, so what are they going to do? They're going to supply enough to meet demand of the foreign currency. At the exchange rate they prefer, the total profit supply is not enough, so the government's going to have to be filling in the difference. So what does that mean? They're going to be selling their foreign exchange reserves. You need more supply than you can get from private agents, so the government